Good day. My name is DJ Peterson. I'm the president of Longview Global Advisors, a Los Angeles-based firm that provides market intelligence, transactions, and political risk management advisory support to investors and corporate executives. Today we're going to be discussing private equity in the Trump era and how the political and policy environment is shaping the business environment and opportunities for private equity in particular. Joining me is John Duncan. He is principal and founder of Meridian Research Group, a Washington-based provider of public policy research and analysis for asset management firms. I've worked with John for a long time, and key themes he advises on are fiscal policy, financial services regulation, government-sponsored enterprises, energy, healthcare, technology, and telecoms policy. In John's previous roles, he served as director of policy at the Commerce Department in the mid-90s. He was an advisor to Speaker of the House, Newt Gingrich. Jason Thomas is a managing director and director of research at the Carlyle Group. He focuses on economic and statistical analysis of the Carlyle portfolio, asset prices, and broader trends in the global economy. Jason also serves as the advisor to the firm's corporate, private equity, and real estate investment committees. And in an earlier role, Jason served as White House staffer as special assistant to the president and director for policy development at the National Economic Council. In this capacity, he served as the primary advisor to the president for public finance. So we have an advisor and a practitioner joining us today. I wanted to open with a few comments, though, to frame what is a very volatile political environment that we find ourselves in, and it's quite unusual. First of all, I think it's really important to understand that there's a vast field of play. There's a lot of issues on the agenda that the president has outlined an ambitious policy agenda on healthcare, tax reform, infrastructure, deregulation, revisiting trade agreements, immigration and border security, just to name a few. And then you throw in the wild cards such as geopolitical developments, as well as president's tweets, and as we've seen this week, revelations around the FBI and the Comey memo. So you have a vast field of play, a lot of issues on the table. How do we make sense of this, and what does it mean for private equity? Now, despite the Republicans control the government and Congress, many proposals on the table are dividing the party and the business community. As you know, there's the border adjustment tax, immigration policy, interest deductibility, and trade policy. And of course, the recent headlines regarding Russia, the FBI, and the Comey memo are just further stressing Republican unity. And the question is, I think today is, how does this all impact the policy agenda? It's also important, I think, for investors to note that the administration is still staffed very thinly. The administration is deferring to Republicans in Congress to shape health care and tax reform. They don't have the people in place to drive the policy and regulatory agenda. They don't have the people in place, for instance, at the EPA to drive their deregulation agenda. Robert Lighthizer, the U.S. trade rep, was only confirmed about a week ago. In foreign policy, there's only one senior China person on hand, and they are a holdover from the Obama administration. So I think these factors can explain why the administration's recent trade deal with the Chinese has been panned by many. So given all this, an intense geopolitical environment, the markets, though, have been very buoyant to date, and market volatility has fallen to new lows. So in our discussion, I really want to address some of these issues about the tensions between what is reality, what is potential, and maybe what are unrealistic expectations. So while we're going through this conversation, remember people can submit questions via the question box on the screen, and you can also tweet using the hashtag #SR webinar. So let's just dive in and look at the policy issues to date. I think it's quite striking if you're looking at the headlines this week. A lot of political noise But the question is what does it really mean for investors in private equity? And John, I'd like to start with you and ask, given all the noise in Washington, you're in Washington, what are you telling your clients about what they're seeing on television, and what does it mean for the markets?
Well, thanks, DJ. Thanks for the opportunity to speak this morning. I'd say for the most part, the drama and the noise that we see, particularly related to the Russia investigation, in my view, has been certainly a drag on the ability to get to closure on some key policy issues, but not something that is having a fundamental effect on the outcome, at least yet. It's possible that with some of the newer revelations, we're at an inflection point and that's changing. And the implication is just a increase in the level of distraction and inability for the White House, for the president to really play the role that is necessary, the leadership role that's necessary in bringing Republicans together on a number of the controversial issues that they're faced with. So it's really just the opportunity cost is the biggest implication of a lot of what we see in terms of this controversy. But, setting that aside for a moment, my view remains that the probability is high, or at least it's relatively high that we end up with a bill that would, repeal and replace the Affordable Care Act. This is the bill that the House of Representatives has passed, that the Senate is currently deliberating over. And I would say that the probability of that bill passing the Senate in the July timeframe is in the 60% range. Tax reform the two things are changing on tax reform. The scope of tax reform is narrowing from what was contemplated over the last year, and the timeline for getting to closure is lengthening. And that, I think, tax reform more so than healthcare is impacted by a lot of the controversies and distractions that we see out of the White House. So we can talk in greater detail and drill down on tax reform, but at a high level, that would be kind of my top line view of the situation.
Thanks, John. And Jason, you're based in Washington as well, so you're very close to these events. What are you telling partners and investors how to read the political environment, what they're seeing on TV?
Well, thanks very much for the invitation to speak this morning, first of all. In relation to your question, I would say an interesting research question that's been posed to me is why has the market not responded to these revelations? And I think that the first, as John suggested, that the time frame for tax reform has certainly lengthened. The probability that any of the Trump agenda items get passed in 2017 is certainly lower today than it was at the start of the year. So why is it that the S&P 500 broad stock indexes are all up by 7 to 9% over the past 5 months, even as the probability of swift enactment of the Trump agenda has declined? And I think the answer to that is that the financial markets have become progressively assigning lower and lower probabilities to enactment of the Trump agenda really since the time of U.S. Thanksgiving. If you look at the biggest winners in sectors in the 3 weeks following the surprise election outcome, it was steel, metals and mining, concrete, financials. Really, all these industries that were expected to benefit greatly from construction of a wall on the southern border, from a large deficit finance infrastructure package. And if you looked at the biggest losers during that period, it was the Mexican peso, which dropped another 8% after falling 20% against the U.S. dollar during the course of the campaign. Of course, long-duration Treasury securities, because of the expectation of larger deficits, higher U.S. real interest rates. The 10-year Treasury fell in value by about 6%. The interest rates rose by about 55 basis points. And then, of course, emerging market stocks sold off because of expectations of a stronger dollar, perhaps related to the higher U.S. real interest rates, but also perhaps related to a border tax adjustment. And if you look at the performance of markets since U.S. Thanksgiving, really since December 2016, you see quite a reversal. Metals and mining are down 11%, steel down 10%, energy down 8%. The dollar, of course, is sold off against major currencies by about 3%. On a trade-weighted basis, the dollar's down even more, by about 4.5%. The biggest winners have been emerging market stocks. The peso has rebounded about 11%. So it's been interesting to observe that the quote-unquote Trump trade, or those industries that were most impacted by the expected policy shift, have in fact been the industries that have most underperformed relative to the market as a whole since November. And the reason the market has performed as well as it has is because of earnings. You have earnings growth in the first quarter that is between 13 and 15%, depending on the index and the constituents you use. This is the fastest year-over-year earnings growth since the V-shaped recovery in corporate profits of 2010, 2011. And you also clearly have a lot of evidence, certainly we see in our portfolio, of a global economic recovery, better performance in Europe especially, but also China and emerging markets more broadly. So I think that we're paying very close attention to these issues. They do have huge ramifications in some circumstances, but it's been very interesting to see how the market as a whole has shifted from hyper attention and focus to the Trump agenda to essentially looking through the headlines to increased focus on economic fundamentals and company performance.
That's a fascinating argument, and I think it's really important to keep in mind, because one of the questions that we've seen is, drawing an analogy to the political environment, how much will the macro political environment change, or by the sort of like the Trump phenomenon, or how strong are American institutions and practices, obviously laws and trade agreements. There's a growing sense out there that actually the needle might not move so much with regards to, say, China trade or our relationships with our trading partners in Europe. John, I want to turn back to you, and looking back now over the last 4 months, you mentioned healthcare. In terms of the investment environment, what would you say are some of the biggest developments or accomplishments to date?
Well, I think with regard to healthcare, there are the legislative environment is focused on two phenomena. One is deregulating and stabilizing the market for individual insurance, and the second is in removing or reducing the subsidies available in the Medicaid marketplace. And those are sort of the two fundamental components of the so-called HCA, which is the acronym for the bill that's being contemplated in Congress at the moment to repeal and replace the Affordable Care Act. Again, my view is the probability of enactment for that bill remains high, at least in the 60% range. The direction of the bill at this stage is to enhance, marginally enhance the support that would exist for beneficiaries in the individual market relative to the version of the bill that passed in the House, and to constrain to some degree the level of subsidy and support that the federal government will provide in the Medicaid market, but still make substantial changes in both areas. So directionally, that's where things are headed. I should probably mention, even though it's sort of peripheral to the way you frame the question, but in the way that what the slide presents, but the question of drug pricing is something that's certainly on the minds of investors, and implications of the drug pricing debate for the pharmaceutical sector. My view is that we're going to get policy change there. That policy change is going to be more focused on the generics market than it would be branded pharma, but that it's going to be, policy change that is going to be more focused on facilitating greater competition in the generics market as opposed to any imposition of price controls. So, that's in big part a function of the fact that you have this is an area where you've got a divergence between the president's rhetoric and sort of the level of emphasis on this issue from the president relative to what the Republican Congress is focused on. And in this area of drug pricing, you certainly, the big policy changes are ones that the Congress is responsible for. So that's really what drives the outcome there. On the, just one more comment on the sort of broader question of the Affordable Care Act and sort of the impact on the individual market and Medicaid. That is an area where even though it may not, appear to be the case on a day-to-day or even a week-to-week basis necessarily, you've got, at least in terms of the end game, a fairly high level of alignment among Republicans in Congress and between Republicans and the White House. And, the conflict is largely tactical in nature. So there's greater alignment in the area of the Affordable Care Act than there is in the area of drug pricing.
Thank you. Given Jason, given what John has just talked about and his outlook for passing of the Republican bill sometime this year and the probability around that, how are you viewing health care reform? And are there specific sectoral opportunities and risks that you see out there?
Well, first, I think it's important to note that the Republican health care bill would reduce spending in the sector quite substantially, initially by about $1.2 trillion, somewhat less than that in the second iteration of the bill. Perhaps that'll fall somewhere to $500 or $600 billion over 10 years. But still, that's quite a bit of money that's essentially coming out of the system. So public support that exists for payments, for payors, for providers, for insurers is being reduced substantially. So I think that we shouldn't lose sight of that. That should be the first point when thinking about the impact on the sector. Secondly, I would say that some of the changes with respect to regulation certainly increase the challenges of ensuring the individuals with predictably high costs, whether pre-existing conditions or otherwise, those who the sick and certainly the poor. I think that of course the greater flexibility to craft plans, the greater flexibility with respect to pricing does open up some channels, some opportunities in terms of structuring plans and at-risk insurance models for different populations that where there's a bit more profit opportunity. But in general, I would just say that the basic framework for thinking about healthcare, the sector in the U.S. and other advanced economies, is one where there continues to be immense cost pressures, and we continue to believe that it's low cost of care facilities and providers, and then those willing to take at-risk business models, which whether it's Medicare or Medicaid share savings or integrated health systems, accountable care organizations, all of those entities that are essentially willing to provide care at a fixed rate and profit to the extent that they can deliver care more efficiently, of course lose in the event that that the total cost of care is in excess of the payments they receive from the government. I think that basic framework should survive intact. I think that the ACA, of course, dramatically increased the number of high deductible health plans because of the need to maintain or meet the premium thresholds. Of course, that meant that there would be larger copay and co-insurance. I think that the expansion of high deductible health plans and more consumer-oriented care is something that Republicans are likely to expand on. So, I think again, it's this money that's coming out, the specific issues that John mentioned with drug pricing and reform of both generics and also the branded and pharmaceuticals are critically important to the near-term outlook. But I think that, again, over a 3, 5, 7-year investment environment, the basic framework seems largely unchanged, with the exception of, again, the large reduction in total healthcare spend that would be effectuated by the AHCA.
It's interesting that you return to this theme of what is really changing and what actually may be staying the same. If you look at tax, I think you could say the same thing. There's a lot of expectations around tax policy changing. And John, we've talked about healthcare. Healthcare has a huge implications for what goes on and what comes down the pipe in terms of tax policy. Perhaps you could start by just talking about your kind of the timeline and how to think about potential tax policy changes. We heard from Jason that he has put off his expectations for action this year. John, what's your expectations in terms of timing? And then perhaps you could dive into some of the specifics and likelihood around them that you see out there.
Sure. So my view is that there's a 40% probability of a substantial tax bill being passed in 2017, 30% in the first half of 2018, and then 30% not at all. Those numbers are shifting. If they're shifting in any way, they're shifting out. And the likely flipped, where the probability of the bill being enacted this year is declining somewhat more, and either steady or maybe marginally rising, that it would occur next year. That's largely a function of the Congress and particularly the White House not focusing and pivoting to tax reform to the degree that's necessary to get closure on a lot of these key issues. Whether it's tax reform or whether it's healthcare for that matter, the conflict here is certainly not one that's bipartisan. Both of these bills, the healthcare bill and the tax bill, are being passed. There's special procedures being used that enable them to be passed on a purely Republican basis. So the effort in both cases, healthcare and tax, is to get unity among Republicans, not to forge a bipartisan compromise. In fact, I would say the more that you hear about bipartisan compromise on either of these bills, the lower the probability should be and the further out the timeline should be, because there really is very little bipartisan agreement about these two issues, and it would be very difficult to achieve. So really, this is the outlook on both these issues, is a function of unity among Republicans. And, the White House has a key, and the President has a very key role to play in achieving that unity. So the degree to which, the White House is focused on other matters, that's the opportunity cost that I referenced earlier in the call. On taxes, the outlook again is not just that the timeline's lengthening, but that the scope of tax reform is narrowing, and that's just a function of the difficulty in making the trade-offs on the Republican side that are necessary to get to a comprehensive tax reform bill. And again, I'm kind of implying this, but just to be explicit about it, achieving Republican unity in the case of tax reform is a function of the Republicans and their ideological and sort of economic view of the world that tax reform is a positive versus the parochial concerns they have on an industry by industry basis. So that's where the real conflict is. So comprehensive, there's two versions of a tax bill, and as I said, the scope's narrowing. The one scenario would be a comprehensive bill that both reduces marginal rates and moves to a so-called territorial tax system where there's little to no U.S. corporate tax burden on U.S. profits generated overseas. And the lowering rates, of course, would take place both on the corporate and individual side. And then in the context of a comprehensive bill, there would be quite a few structural changes to the tax code, the two most high profile of which would be the so-called border adjustment tax and also the move to full expensing of capital investments with an offsetting limit or elimination on the deductibility of interest expense. What I just described is the comprehensive tax reform bill, and part of what makes it comprehensive is that not only does it make this large and wide-ranging set of policy changes, but it does so in a revenue neutral manner, and that's part of the catalyst for making some of these disruptive changes on a industry by industry basis. Whereas a more targeted tax bill would not have the revenue neutrality goal, and therefore would, the catalyst wouldn't exist for making some of these difficult trade-offs that negatively impact certain industries. But even in the context of a targeted tax bill, you would have rate reductions on the corporate and individual side, and you would also have changes in the international tax regime for the U.S., moving to a territorial system and then doing a one-time mandatory repatriation of profits. Those two items, very substantial in nature, would exist even in the case of a targeted tax bill. So at this stage, I put the comprehensive bill in about the 40% probability range, the targeted bill in the 60% probability range. What's not included in a targeted bill would be a border adjustment tax, and then many of the changes on individual deductions and credits that would be disruptive on an industry by industry basis. Those items are not included in the 60% probability scenario.
Got it. So you've got this distinction between comprehensive and targeted tax. You also have the macroeconomic effects, the sector effects, and then the private equity industry effects. I want to drill down to a very specific question, obviously shaping the private equity industry. Ryan McGovern has asked the question, will the carried interest tax treatment be changed? John, what's your call on that right now?
I'd say marginally above 50% that we'll see some change there, and that's the case because, it's a political deliverable that is, not only has the president promised, but you've seen some degree of sympathy to it over time on the Republican side, and in order to, be able to defend a lot of the benefits that will occur for firms and for wealthier individuals. This is something that has an offsetting political value that really plays to the populist sentiments that exist in the country. So, there are some direct pieces of evidence of sympathy on the Republican side, not strong. And then there's the political rationale that I laid out. And so that's why I would, on balance, argue for slightly above 50% probability. But, you do have a, this is generally an issue that is not particularly popular among Republicans. You've got an industry that is effective in making its case that would be negatively impacted by it, and that industry is not just private equity, but it's other elements of the investment sector, particularly ones that are more sympathetic politically, such as the venture capital industry. And so, there is countervailing pushback. But if I was to make a bet at this stage, I'd say marginally above 50%.
Thanks for making that call. Again, I remind people to submit questions via the question box on their screen or to share their thoughts as well. Jason, I wanted to turn to you specifically on this question. Obviously, I imagine your firm has a strong point of view on carried interest. But any reflections or comments that you'd like to add to John's observations?
Well, I would say that that tax reform is of course extraordinarily complicated from the perspective of both the taxpayer and the policy analyst trying to understand what's likely to happen and what the ultimate effects would be. I think that the notion of border adjusting the corporate income tax was something that certainly took most of the attention of observers because of what the dramatic effect it would have on specific industries. And I think that was something that there was potential for not just incremental costs, but something that I think investment professionals viewed as being catastrophic in certain cases and in terms of certain investments that they would make. I think that it's also interesting that the notion of border adjusting the tax comes at a time when the retail industry is hurting to the extent that it is. If you're a distressed investor, whether in real estate or in corporate debt, chances are about 75 to 80% of your targets are in the retail space. Whether it's malls that are suffering because of lost tenants, or the equity or the CMBS issued against those malls, or it's the retailers themselves. This is an industry that is certainly going through a very difficult adjustment, both to the competition from online retailers, but also from just changed cultural circumstance. When you look at casual dining restaurants that are at malls, they're also suffering. They're certainly not impacted by Amazon. It's just that people are not spending their weekends or evenings to the same extent visiting malls and then going to those chain restaurants. So I think the notion that there's this the exogenous shock that they're experiencing, adding to their woes through a border adjustment tax is something that it seemed to have torpedo that, and I think that again it was interesting from an investment perspective because it's not simply a proposal that would marginally impact an investment target. It would be sort of a night and day difference that either this looks to be a very attractive opportunity and we should pursue it, or in the event of a border adjusted corporate income tax, then we shouldn't touch this at all. So it's rarely do you see such a binary outcome with prospective investment targets, and that I think again just how dramatic that was really made that much less likely for passage. I would just say from my own perspective of having worked in government previously that in 2006 or 7 the Treasury Department released strategies for corporate tax reform, revenue neutral, and just how challenging it was, and included in that was a border adjusted tax. It was actually moving the corporate income tax to a business activity tax, or essentially a subtraction method, VAT. And that in that case, I thought it made sense because the effective tax rate would have only been about 4.5%. So a business activity tax, the tax base is extremely large. It's about 41% of GDP. So to collect the same amount of tax as the current corporate income tax, you can have a very, very low rate of about, again, 4.5%, maybe slightly lower. And that sort of border adjustment tax is really just not that consequential. You have a currency adjustment of 4% or a move in the price level of 4%, or any number of other smaller dynamic effects that essentially cancel that out. When you're talking about a 20% tax rate, well, now things are quite different. and now the notion of currency adjustments or price level adjustments or other effects, there's quite a bit of model risk in the sense that what you think may happen if you get it wrong, that there's a potential catastrophe at the other end. So I think it's not just the notion of a border adjustment. It's the fact that it's a 20% tax that made it so consequential. But overall, I think that getting the tax rate down to a level where the statutory tax rate is in line with the effective tax rate makes sense. The effective tax rate on U.S. corporations is between 22 and 25%, depending on the year and the total level of corporate income. So, I certainly very much hope and I think that it would be quite helpful to the outlook should they succeed in this narrower, more targeted version that John discusses.
Thanks for breaking that out. John, I wanted to pivot back to you and ask about interest deductibility. What do you think is the likelihood that that provision will be changed in either a targeted or a comprehensive package?
I would say that is something that I would put marginally below 50% probability at this stage, with the overall probability of tax reform being, much higher, as I noted, in the 70% range. So, but I would say that it is certainly elevated and more elevated than it was ever the case with the border adjustment tax. And the reason that that's the case, there are a number of reasons that that's the case. The first is that it is, for both budgetary and policy reasons, a change in the deductibility of corporate interest is typically associated with another significant change in this plan, which is the move to full expensing of capital investments. That tie is one that is not necessary, but it is it does exist to a large degree, again, because of policy and budgetary reasons. So on a budgetary basis, well, and I should note that tie is important because the move to full expensing is one of the elements of the plan that, many would assert, Jason, of course I would defer to his opinion on this, but, many in a policy and political context would assert is one of the more growth-inducing elements of what's being contemplated. But and it benefits a wide range of industries. It's a significant positive on a policy and political basis, and so the degree to which interest deductibility is tied to that attractive provision of full expensing is certainly a strong catalyst for a change on interest expense. So you have that dynamic that's raising the probability. You have the fact that moving to full expensing reduces federal tax revenue, in the $800 billion to $1 trillion range, approximately. Jason may have other estimates, but depending on some third-party estimates you defer to, it's in about that range. So it's substantial, and interest deductibility would raise, if you were to eliminate it entirely, would raise approximately that amount over a 10-year period. So that is the budgetary catalyst, in terms of which is dependent on the two being tied. You also have various policy rationales that exist, outside of just the budgetary tie between the two. One being, if you were to both have full expensing and deductibility of interest expense, on a distributional basis, that would be, probably not viewed as a appropriate distribution of the tax burden or lack of a tax burden on capital versus other elements of taxation. You also have the policy rationale that's not widely held. I mean, you typically think of it or hear about it in academic and think tank circles, but not as much, in the broad political environment. But the notion that providing a tax subsidy to debt, results in inappropriate incentives and creates inappropriate risks in the economy, that exists in, again, some circles, but is not a strong reason. So for all these reasons, you have this tie between interest expense, limiting it or doing away with it, the deductibility of it, and full expensing of capital investments, as well as some separate policy rationales. But then, of course, eliminating or limiting the deductibility of interest expense would be highly disruptive to many industries, not just the private equity industry, but other highly leveraged industries. And so that creates a high degree of controversy, which is what, contributes to a lower probability than would otherwise be the case. The other thing that I would note on this point is just that, you could contrast the significant degree of pushback politically on something like border adjustment to the limited amount of pushback that you see on the change to interest expense. Now, that's partly because I think many that are affected by the change in interest expense are just sort of biding their time and sort of until tax reform gets to a more advanced state and sort of letting the border adjustment tax take most of the heat up to this point. But it is worth noting that, I think in part because you have, some winners and losers in the interest expense debate, but some who are affected but who are net winners in the overall scheme of tax reform that diminishes the degree of pushback that you get around changing the deductibility of interest expense. That I think depresses the pushback to some degree. And you have just a narrower range of industries that are impacted relative to what was the case on border adjustment. So for all these reasons, I would say the probability is elevated, but at the end of the day, particularly because we're talking about a more targeted bill to begin with, I think I would put the probability somewhere below 50%, but certainly at an elevated level.
Right. So if we take this argument that perhaps a more targeted package will come through, Jason, I want to return to kind of your observation, looking out 3, 5, 7 years, in the kind of contrasting between market fundamentals and the potential impact of a health package. A tax package. Do you see the U.S. the economic environment, macroeconomic environment, or sectoral environment changing significantly in 3 to 5, 7 years? As a result of a tax package that is passed next year.
Well, I think that the benefits of tax reform are real, but perhaps overstated by proponents. So I do think that there's a lot of deadweight cost in the system associated with transfer pricing, tax planning, and I think that an international reform is very important to try to relieve companies of that burden, to simplify things, to have a low rate applied globally, or move to a territorial system, or other potential reforms. I think that again, a move to create greater incentives for investment is certainly helpful. I think that what was interesting, of course, in the initial House bill, the blueprint, was how expansive expensing provisions would have been, so as to include all buildings. Land, of course, cannot be expensed, but when you think about buildings, they're currently depreciated over 39 years. This would allow for immediate expensing in year one. That's extraordinary, and I think that thinking through the impact on real estate development, the cost of the impact on existing buildings in relation to newly constructed buildings was very interesting to think through. I think that's much less likely that becomes reality now, as John suggested. I think with interest deductibility, it's important to note that the current tax regime is symmetric in that interest deductions are favored. Of course, you get to deduct interest. You don't get to deduct dividend payments. But on the flip side, on the individual tax side, the creditor side, interest is disfavored. Your interest payments that you receive, your coupon interest payments, are includable in your gross income, and they're taxed at your individual marginal rate. So, taxed over 40% current coupon income. Conversely, of course, your capital gains on dividends are taxed at a preferential rate of a low of 20% or 23.8% when including the HCA surtax. So I think that if there is a policy change, it has to be symmetric. If there's going to be a haircut on the ability to deduct interest, there has to then also be some exclusion for taxpayers to reduce their the interest income that they receive from corporates. And if there's not, I think that that's a problem because that you're actually undoing the current symmetric treatment that exists. And again, the roadmap eliminated interest deductibility, which I think would be harmful and disruptive, but it did so at the same time as treating interest the same way for individual taxpayers as dividends and capital gains at the same preferential rate. So at least it acknowledged the current symmetry that exists, and movement to a future regime would be symmetric. Now, again, I don't think that would have. I think that would have been more harmful than the current system because of the disruption. But again, the fact that it acknowledged the symmetry, I think it was helpful and something that, again, I certainly hope policymakers keep in mind as they think about cobbling together a more targeted narrow tax provision.
Got it. Let's move ahead to deregulation. As I mentioned earlier, there's a broad field of play out there. You've got energy and environmental deregulation being talked about. I've got obviously financial services. You've got the laws and the rules, and then of course you have tremendous impact of personnel changes in the regulatory bodies. A number of things we can talk about. I encourage people to chime in with questions if they have specific issues they want addressed on healthcare tax or regulation. Greg Durst asked specifically about changes for SEC registration for funds. John, what's your take on that? Have you put together a view on that?
It's not an issue we spend too much time on because it's not one that I think is going to be changing dramatically. I mean, there is some possibility of an effort to reduce the compliance burden, particularly for smaller funds. But in terms of a dramatic shift away from registration for larger funds, I don't think the move on the push on the industry's part in that direction is intense enough, to result in significant relief in that area. But I would say that the leadership of the SEC is going to be very open to listening to industry on all dimensions, and certainly the direction from the White House is to, and from the Republicans in Congress, is to take a fundamental relook at all aspects of Dodd-Frank. And so the degree to which the industry is able to articulate that registration presents an inappropriate burden, then I think that there'd be some openness to it. But I don't sense that there is, at least among larger funds, as much of a push there. Maybe on the smaller fund side.
Mm-hmm. And Jason, given all that's being talked about on the regulatory front, I'm curious, what opportunities or where do you see the greatest upside? Where are you looking for significant new opportunities in terms of things coming down the pike in terms of deregulation or the regulatory environment more broadly?
Well, I think that there's two areas. The first is energy infrastructure, and the second is financial services. Energy infrastructure, when you think about the role of federal permitting and environmental review, staffing changes in outlook, changes in rulemaking, administrative changes can really have a big impact in terms of green lighting, investments in pipelines and other related infrastructure. So I think that's important because delays there have really deterred investment. And there's, of course, outright difficulties with getting siting and projects approved. But just this notion that this is whatever you do is going to be very, very time consuming, I think again has led to deferred investment. So, and I think quantitatively that the numbers could be very large in terms of tens of billions of dollars annually that could actually be deployed with some projects. And I think that's interesting to see, and that's not something that requires legislation. Secondly, in financial services, I think that this is a very interesting market today. Financial services as a sector grew much faster than the broader economy for essentially 100 years prior to the Great Recession. In the post-war era, financial services grew about 5% per year as the broader economy grew at 3.5%. This was known as financial deepening, just this idea that the economy becomes more efficient as savers have more opportunities to deploy savings, more sophisticated intermediation to match deficit and creditor units, et cetera. And this reversed in the years after the financial crisis, where the financial services industry has grown. Gross receipts have grown about 1% per year as the broader economy has grown about 2%. And I think that there's a lot of pent-up innovation, a lot of pent-up demand, a lot of just a sea change in attitudes about instead of conservative balance sheet management, actually starting to be willing to take some risks and invest in new business units, invest in new financial technology. I think the fintech space is very overpriced at the early to late stage venture part of that market, but I think there's certainly a lot of innovations where there could be acquisitions by banks, by asset managers, broker-dealers, et cetera. And I think that there's a regulatory climate today that is going to help to facilitate some of these growth strategies. I think new regulators in place at the Federal Reserve with respect to the vice chair for supervision, changes at the SEC, CFTC. I think that in looking at this broadly, that there doesn't need to be repeal and replace of Dodd-Frank for there to be enough breathing room to change the orientation of the industry and the management teams to pursue growth again instead of just conservative management and meeting distribution. So I think, again, energy infrastructure and financial services are areas where you don't need to have an unrealistic expectations about what can be achieved legislatively to be favorably disposed for investments going forward.
Yeah, I would agree. I think what we're seeing for sure is that you don't necessarily need changes in the rules, but just the tone at the top, and obviously enforcement can play a big role in setting the agenda. But I think that's very important, and again, and to keep in mind in this environment, at least where there's so much political noise going on, and there's a lot of the big headlines, is to really be paying attention to some of the finer details of what's going on. Jason mentioned infrastructure. Our view has also been that expectations in the market about a big infrastructure package are way overblown, and especially now that you see more partisanship and other issues, healthcare and tax slowing down. What is the prospect for infrastructure? John, what's your latest call?
Well, I would concur with Jason that the primary impact in the infrastructure arena will be related to a reduction in the regulatory burden associated with deploying infrastructure. But, from even before the election and watching, the prospects for an agenda under candidate Trump, we've had the same view that we have now, which is the probability for any incremental government spending on infrastructure is very low, very limited. In the case of healthcare and taxes, as I noted, despite all the drama, there's basic alignment among Republicans, between Republicans and President Trump, in the case of energy and financial regulations, Jason articulated very well, that is something that can largely be achieved via the president's authority. But in infrastructure, there is a divergence in the views between what Republicans in Congress see as priorities and what the White House and the president's, at least what his rhetoric would suggest. That's not to say that Republicans don't like investing in infrastructure. They do. I mean, there's broad Republican support for recent large-scale infrastructure bills, to deal with highways, that deal with water infrastructure. But it's a question of two things. One, prioritization, and two, from a budgetary standpoint, how do you offset the incremental spending in infrastructure? And the president seems to have infrastructure as a high priority. It is not at the same level of priority among Republicans in Congress relative to the other things they want to accomplish. And then on the question of the budgetary implications, Republicans are generally speaking, not entirely, but generally speaking, open to allowing for an increase in the deficit on the revenue side of the equation, but are highly focused on ensuring that any incremental spending, including infrastructure spending, is fully offset by either incremental revenue or savings elsewhere in the budget. And that's where the difficult, trade-off always exists on infrastructure policy in the U.S. is finding those budgetary savings or additional revenue to offset infrastructure spending on the government's part. And there's really limited progress on that front among Republicans and with the White House. So I'd say that the infrastructure opportunity is much more one of deregulation in that sector as opposed to incremental government spending.
Mm-hmm. We have a few minutes left. If there's any last-minute questions, please chime in. But maybe use this opportunity to touch on trade very, very quickly. Again, there's a lot of noise. There's a lot of ambition around in Washington, at least in the administration, in terms of redefining our key trading relationships. But in fact, maybe not as much will happen as we've been led to believe. Jason, any quick thoughts on the trade outlook and the implications for the market?
I agree with the notion that there's likely to be policy stability. Here's another area where the potential impact was catastrophic, and it's really with respect to Mexico. You think about Mexico has a gross external deficit. It runs annually of about $60 billion US dollars. That's covered in two ways. First, $30 billion comes from remittances, essentially money sent home from Mexican nationals that are working in the United States, and the other $30 billion largely comes from foreign direct investment, which is U.S. businesses, also global corporations that site facilities in Mexico largely for export to the United States under NAFTA. Also, about 80% of Mexico's exports go to the United States. So this is an economy that is really uniquely vulnerable to a dramatic shift in trade policy. And it was, I think, it was not surprising to see the way that the currency, the peso, and Mexican asset prices responded to the rhetoric. But I think, thankfully, that appears to not really be as great a risk as it once seemed. President Trump, of course, announced the intention to renegotiate NAFTA rather than withdraw unilaterally. And I think that this is a signal that trade policy more broadly is going to look more similar than we would have thought based on the campaign.
Yeah, it's very interesting. I think it's also important to note that from a geopolitical perspective, what's going on here in Washington, there's a counterpart elsewhere in the world. So as we think about renegotiating NAFTA, Mexico is going into a major election, presidential election next year, and to the extent the flexibility that policymakers in Mexico will have to strike a deal will become much more limited. So if the U.S. is seen as bullying Mexico, that could raise the prospects of a nationalist backlash, a populist backlash in the coming election next summer in Mexico. If you look at Asia, the TPP nations are looking to move the agreement forward without the United States, and so that can have that might have significant implications for investment opportunities and trade patterns. So I think it's very important to look abroad. We've reached the end of our time, and I wanted to thank Jason and John for joining us and sharing their views. All three of us will be at Super Return US East in Boston in June, and look forward to speaking with participants and audience members then. In the meantime, we encourage people to keep up to date with the latest Super Return news at www.superreturnlive.com. Until then, goodbye.